Hey everyone, welcome back to the channel. If you're new here, I'm Chloe William, and I'm here to help you navigate the world of investing one step at a time. Today, we're diving into a hot topic that I get asked about all the time: ETFs versus mutual funds. Both are incredibly popular investment options, and for good reason. They both offer a fantastic way to diversify your portfolio and participate in the market. But with their differences come important considerations. Which one is the right fit for unique financial goals and investing style? That's what we're going to unpack today. So grab your notebooks, settle in, and let's break it all down. First things first, let's start with the basics. What exactly ETFs and mutual funds? In a nutshell, both are investment vehicles designed to pool money from many investors like you and me. This collective pool of money is then used to buy a diversified portfolio of assets. Think stocks, bonds, or even other securities. This built-in diversification is a huge plus, as it helps spread risk and potentially enhance returns. Now let's dive a little deeper into each one. ETFs, or exchange-traded funds, trade on stock exchanges just like individual stocks. This means you can buy and sell them throughout the trading day, just like you would with any other stock in your portfolio. Mutual funds, on the other hand, operate a little differently. They're bought and sold directly through an investment company or a brokerage firm. Unlike ETFs, mutual funds are priced once per day after the market closes. So you place your order and it's executed at that end-of-day price. Now that we've covered the basics, let's explore some of the key differences between ETFs and mutual funds. Both investment vehicles have their own unique characteristics, and understanding these can help you make more informed decisions. Understanding these nuances will help you determine which one aligns better with your investment strategy and preferences. Whether you are a seasoned investor or just starting out, knowing the pros and cons of each can significantly impact your financial goals. First up, let's talk fees and expenses. Generally speaking, ETFs tend to have lower expense ratios than mutual funds. This is because ETFs are often passively managed, tracking an index, whereas mutual funds are frequently actively managed, requiring more resources and higher costs. This means you'll typically keep more of your returns in your pocket, which is always a good thing, right? Lower fees can compound over time, leading to significantly higher returns in the long run. However, keep in mind that since ETFs are traded like stocks, you'll likely pay brokerage fees when you buy or sell them. These fees can add up, especially if you trade frequently, so it's important to factor them into your overall cost. The second key difference lies in their flexibility. ETFs offer real-time trading flexibility throughout the trading day. This allows investors to take advantage of market fluctuations and make timely decisions. This means you can buy or sell your ETF shares at any point during market hours, allowing you to react to market movements as they happen. This can be particularly beneficial in volatile markets where prices can change rapidly. Mutual funds, as we discussed, are priced and traded once a day after the market closes. This means you won't know the exact price at which you are buying or selling until the end of the trading day. Finally, let's consider minimum investments. Mutual funds often come with minimum investment requirements, which can vary significantly depending on the fund. These minimums can sometimes be a barrier to entry for new investors. You might encounter minimums ranging from a few $100s to several $1,000s. This can limit your ability to diversify your investments if you are starting with a smaller amount of capital. This can be a barrier for new investors or those working with a smaller budget. It's important to consider these minimums when planning your investment strategy. ETFs, on the other hand, generally don't have minimum investment requirements. This makes them a more accessible option for many investors, especially those who are just starting out or prefer to invest smaller amounts. You can often buy as little as one share, making them a more accessible option for many investors. This flexibility can help you build a diversified portfolio without needing a large initial investment. So, we've covered the basics and highlighted some key differences between various investment options. Now let's dive deeper into the pros and cons of each investment vehicle to help you make a more informed decision. Remember, there's no one-size-fits-all answer in investing. Each option has its unique benefits and potential drawbacks. The best choice for you depends on your individual circumstances, goals, and comfort level with risk and market fluctuations. Let's start with the advantages of ETFs. These investment vehicles have gained popularity for several compelling reasons. As we've discussed, one of the most significant advantages of ETFs is their lower expense ratios. This means you pay less in fees, which can significantly boost your overall returns. This cost-effectiveness can have a positive impact on your investment returns over the long run, making ETFs an attractive option for many investors. Additionally, ETFs are known for their tax efficiency. Their structure is designed to minimize capital gains distributions. This can help you keep more of your investment profits, as you won't be hit with large tax bills at the end of the year. And of course, we can't forget the real-time trading flexibility that ETFs offer. You can buy and sell them throughout the trading day, just like stocks. However, like any investment, ETFs also come with potential drawbacks. It's important to be aware of these before making a decision. While their lower expense ratios are a big plus, remember that you'll likely incur brokerage fees each time you buy or sell ETF shares. These fees can add up over time. This can eat into your returns, especially if you're trading frequently. It's crucial to factor in these costs when planning your investment strategy. Additionally, to invest in ETFs, you'll need a brokerage account. This might be an extra step for some investors, but it's necessary to access the market. Now, let's shift gears to mutual funds. These have been a staple in the investment world for decades and offer their own set of advantages. One of the most significant advantages of mutual funds is that they're professionally managed. This means a team of experts is making investment decisions on your behalf. This can be a huge benefit for investors who prefer a hands-off approach or lack the time or expertise to actively manage their investments. You can rely on the fund managers to handle the complexities. Mutual funds are also a great option for investors who prefer to make regular systematic contributions, such as through a systematic investment plan or SIP. This can help in building wealth over time. However, it's essential to be aware of the potential downsides of mutual funds. They are not without their own set of challenges. As we discussed earlier, they tend to have higher expense ratios compared to ETFs. These higher fees can eat into your returns over time. They also tend to be less tax efficient. This means you might end up paying more in taxes compared to other investment options. And finally, those minimum investment requirements can be a hurdle for some investors. It's important to consider whether you can meet these minimums before investing. By now, you're probably thinking, okay, Chloe, this is all great information, but how do I actually decide which one is right for me? It can feel overwhelming with so many options out there. But don't worry, we're here to break it down for you. That's the million-dollar question, right? The key is to start by understanding your own investment style, goals, and preferences. By doing this, you can make an informed decision that aligns with your overall financial plan. It's not just about picking an investment, it's about choosing one that fits you. First, ask yourself, are you a hands-on investor who likes to be in the driver's seat, or do you prefer a more hands-off approach? This is crucial because it will guide your investment choices. If you enjoy researching, tracking market movements, and making trading decisions, ETFs, with their real-time trading flexibility, might be right up your alley. They offer a dynamic way to engage with the market. But if you prefer to set it and forget it, knowing that your investments are being professionally managed, mutual funds might be a better fit. They provide peace of mind and professional oversight. Next, consider your budget and how much you're comfortable investing. This will help narrow down your options significantly. ETFs, with their lack of minimum investment requirements, are a fantastic option for investors of all levels, especially those who are just starting out or working with a smaller budget. They offer flexibility and accessibility. And finally, think about your long-term financial goals and how taxes might play a role. This is often overlooked but can have a big impact on your returns. If minimizing your tax liability is a priority, ETFs, with their tax-efficient structure, might be the more advantageous choice. They can help you keep more of your hard-earned money. Remember, the best investment for you is one that aligns with your personal financial situation, goals, and comfort level. Take your time, do your research, and choose wisely. So there you have it, a breakdown of ETFs and mutual funds, designed to equip you with the knowledge to make informed investment decisions. Remember, there's no right or wrong answer when it comes to choosing between these two popular investment vehicles. The key is to select the option that best aligns with your individual financial goals, risk tolerance, and investment style. Take some time to reflect on what we've discussed today. Think about your investment goals, your comfort level with risk, and how involved you want to be in managing your investments. Write down any questions you still have, and don't hesitate to reach out to a financial advisor if you need personalized guidance. Investing is a journey, not a race, and the most important step is simply to start. Whether you choose ETFs, mutual funds, or a combination of both, the key is to stay informed, stay engaged, and make choices that support your long-term financial well-being. I hope you found this video helpful in clarifying the often confusing world of ETFs and mutual funds. If you did, please give it a thumbs up and subscribe to my channel so you don't miss out on future videos designed to empower you on your investment journey. And I'd love to hear from you. Are you Team ETF or Team Mutual Fund? Let me know in the comments section below. Until next time, remember, knowledge is power, and the best investment you can make is in yourself. Happy investing!